Hello friends, in today's session I am going to discuss with you the entire roadmap of financial accounting. We all understand the importance of financial accounting. We understand the importance of financial reporting. But where does the financial reporting start from? What are the things that we need to understand to be good in financial reporting or financial accounting? Now, basically, what you see on the screen, this is your roadmap for financial accounting. So, what are the processes in case of financial accounting? Number one, we have to understand what are the types of accounts. So to be good in financial accounting, first thing that we need to understand is what are the types of accounts. And then we need to understand what are the accounting rules. So basically there are three types of accounts, and since there are three types of accounts, there are three types of rules. So we need to understand as to what those three rules are. After that, we need to understand which are the financial books that need to be prepared by any business organization so as to serve the purpose of financial accounting. After that, we need to understand accounting concepts, or rather before we have to understand what the accounting concepts are, and then we also need to understand what is the accounting convention. So what we will do in this session, friends, we would start with the types of accounts. So which are the types of accounts in financial accounting? There are three types of accounts. Number one is the real account. How do you identify a real account? It's very simple. As the name suggests, real, something which is real, and that is the real account. And then you have personal account. Personal means entity. Personal means entity. So when there is an entity involved, that is a personal account. And finally, third account that you have is known as nominal account. And as the name shows, nominal means something which does not have existence as such, but this is the third type of account that we have. Now, what are the examples of these three types of accounts that we have? So when you look at the real account, so your building account is a real account. Plant and machinery account is an example of real account. Bank account is an example of a real account. Inventory is an example of real account. So real means something that is existing. Now, what is the rule applicable in case of real account? The rule applicable in case of real account is the accounting rule which is applicable in case of real account is debit what comes in and credit what goes out. So something which is coming in, debit that. Something which is going out, credit that. You are purchasing raw material, debit the raw material. Since you are purchasing raw material, cash is going out, money is going out, credit the money or cash or the bank account. You are purchasing a plant and machinery is coming in, debit the plant and machinery. When you are purchasing a plant and machinery, you are making the payment, money is going out, so credit the bank account. So that is your first type of the account, that is a real account, and the rule applicable is debit what comes in and credit what goes out. The second rule is personal account. So what is personal account? Personal account, remember, whenever there is an entity involved, it becomes a personal account, and that entity can be anything. That entity can be an individual, it can be a partnership firm, proprietorship firm, or a private limited company, or a public limited company, or a society. It can be anything. So whenever there is an entity, it means it falls into the category of personal account. What is the rule applicable in case of the personal account? The rule applicable in case of personal account is debit the receiver and credit the giver. यानी कि जो जिसको मिल रहा है उसको डेबिट करिए और जो दे रहा है उसको क्रेडिट करिए. So this is, so say for example, you are making payment to a supplier of yours. So your supplier is receiving the payment, debit him. And when you are giving payment to your supplier, remember money is going out. So money is what? Money is a real account. So what you would need to do? You would need to credit the bank account or the cash account as the case may be. The third type of account is nominal accounts. So nominal accounts are what? Nominal accounts are the accounts relating to expense, relating to income. So those are all your all your nominal accounts. So जो भी खर्चे आप बिजनेस में करते हैं वो those are the examples of nominal account. जो भी आप इनकम बिजनेस में कमाते हैं that is your again an example of your nominal account. What is the rule applicable in case of a nominal account? The rule applicable in case of a nominal account is debit all the expenses and losses and credit all the incomes and gains, and that is the rule applicable in case of nominal account. So a quick revision. So which are the three kinds of accounts? Real account, personal account and the nominal account. What are the rules applicable to these three different types of accounts? In case of real account, debit what comes in, credit what goes out. In case of personal account, debit the receiver, credit the giver. In case of nominal account, all the income and gains are to be credited and all the expenses and losses are to be debited, and this is what we need to remember. So the examples of the personal account will be all your debtors, all your creditors, all your lenders are examples of your nominal account. Now what next? Next that we need to understand the accounting concepts. So what are the accounting concepts? The first accounting concept is business entity concept. What does it mean? It simply means that the owner of the business and the business are two separate entities. Owner of the business and the business are two separate entities. Tatas own Tata companies. Tatas are owners of Tata companies. Remember, all the Tata companies have a separate distinct entity from the Tatas, and that is what is the accounting concept number one. Number two is the money measurement concept. What is money measurement concept? Money measurement concept would mean that every transaction which is measured in terms of money is to be recorded in the financial accounting or for the purpose of financial reporting. So only those transactions which can be measured in terms of money are to be recorded or accounted for in the financial reporting. The third concept is the going concern. Now what is the meaning of going concern? The meaning of going concern is whenever someone starts a business, he starts a business to run it for infinity. Nobody starts the business with an objective to close it in a month's time or in a year's time or in a 1 year, 2-3 years time. So going concern का मतलब ये है कि the business is assumed not to be closed in the foreseeable future, and that's your third concept, and that is your going concern. The fourth concept is cost, and meaning what? Meaning every transaction which is recorded in the books will have a cost, and that cost has to be recognized in the financial reporting or financial accounting. The fifth concept is accounting period. So what is the meaning of accounting period? Any business, every business anywhere in the world, remember, will have a distinct accounting period. Meaning what? Meaning the period will start from a date and it will close on a particular date. Why? Because if there is no accounting period identified, then it would be difficult to figure out whether a business is incurring losses or making profit. Why? Because unless and until you close the financial accounts, you will never know as to what the income is and what the expenses are in totality, and as a result of that, how much is the profit or how much are the losses. And finally friends, the sixth concept that we need to understand is known as matching concept. What is the meaning of matching concept? The meaning of matching concept, of course, is very simple. Now what does it mean? It simply means expenses pertaining to an income need to be recorded in the same period in which the income is recorded. That means what? That means if I'm earning income in the current year, then all the expenses that I incur in respect of this income, they got to be recorded in the current year only or current period only. Therefore, the relevance of provisions come in the picture. You know what are the provisions? Provisions are the expenses that we incur in the future in respect of the income that we have earned during the current year or in the current period, and that's your matching concept. And fourth thing that we need to understand before we come to the financial books is your accounting conventions. So what are the accounting conventions? Accounting conventions, there are 4 accounting conventions, and those are: number 1 is consistency. Now what is the meaning of consistency? Meaning of consistency is very simple. आपकी अकाउंटिंग में, आपकी फाइनेंशियल रिपोर्टिंग में आप जो भी करते हैं आप उसको कंसिस्टेंटली करिए. यू कैन नॉट कीप चेंजिंग इट एवरी नाउ एंड देन. सो अगर आप आपकी इन्वेंट्री को लीफो के बेसिस पे वैल्यू करते हैं या फीफो के वैल्यू पे बेसिस करते हैं तो आपको कंसिस्टेंटली लीफो और या फीफो को ही यूज़ करना चाहिए. अगर आपकी एसेट्स को आप स्ट्रेट लाइन मेथड के हिसाब से डेप्रिशिएट करते हैं या डब्ल्यूडीबी के हिसाब से डेप्रिशिएट करते हैं तो इसका मतलब ये है कि आप जो भी मेथड अप्लाई करते हैं डेप्रिसिएशन के लिए आपको कंसिस्टेंटली उसी मेथड को यूज़ करते रहना है. यू कैन नॉट चेंज एनी ऑफ द अकाउंटिंग. दीज आर ऑल्सो नॉन एज अकाउंटिंग पॉलिसीज. यू कैन नॉट, यू हैव टू फॉलो द पॉलिसीज consistently. The second accounting convention is full disclosure. And what does it mean? It simply means, remember, a business is owned by business owners, and therefore the business has a responsibility towards the business owners. Meaning what? Meaning the people who run the business, they are under obligation to make sure that they make full disclosure about whatever is happening in the business so that the owners of the business are well informed about their investment, and that is your full disclosure. Number 3 is conservatism. And what is the meaning of conservatism? The meaning of conservatism is that in your financial accounting, what you need to do, you need to be conservative. That means if an expense is likely to happen, you should record it. But if an income is likely to happen, then you should not record it unless and until it happens, definitely and for sure. So these, friends, are your accounting conventions. So what we have discussed so far, we have discussed number 1, the types of accounts. Number 2, the accounting rules. Number 3, we have discussed is accounting concepts. And number 4, what we have discussed is accounting conventions. Now, friends, we come to the financial books. And in financial books, I would like to discuss with you is there are 3 financial books that we need to worry about. One is profit and loss statement, second is balance sheet, and third is the cash flow statements. So as business, these are the 3 statements that we need to prepare for the purpose of financial reporting and for the purpose of financial control. So what is the balance sheet? Balance sheet is a statement that tells you as to what are your assets and what are your liabilities. Balance sheet से आपको क्या मालूम पड़ता है? बैलेंस शीट से आपको मालूम पड़ता है कि आपकी एसेट्स कितनी हैं और आपकी लायबिलिटीज़ कितनी हैं. सो बैलेंस शीट गिव्स यू एन आइडिया अबाउट द फाइनेंशियल पोजीशन, फाइनेंशियल स्ट्रेंथ और वीकनेसेस ऑफ अ बिजनेस. व्हाट इज P&L tells you? P&L tells you as to how much is the income in the business, how much is the income of the business, and how much are the expenses of the business. Obviously, a profit and loss is good only when income is more and expenses are less. So that is what you will account, that is what your P&L will tell you. So P&L will give you an idea about the operating and financial performance of a business. Balance sheet will tell you the financial strength or weaknesses of a business. And the third statement that we have is the financial statement. So what would the the third statement that we have is the cash flow statement. So what would the cash flow statement tell you? Cash flow statement tell you as to from where the money is coming into the business and where the money is going out from the business. Obviously, how do you figure out whether it is a good cash flow or it is a bad cash flow? Of course, if money coming in, the cash coming in is more and cash going out is less, it means it is a good cash flow. Contrary to it, if cash going out from the business is more and cash coming into the business is less, that means it is a bad situation. And this is how we would figure out as to what the cash flow statement would tell you. So cash flow statement basically will tell you about the cash generating capacity or ability of a business. So friends, this is the entire roadmap of financial accounting. I hope you have found this session useful. If you have found this session useful, please do like it. Not only like it, but also share it with everyone. We will keep coming out with such kind of videos covering different aspects of finance going forward from time to time, and therefore you can also suggest to others to subscribe to our channel so that they automatically get alerts about our future videos. Thank you and wish you all the very best. Thank you.